Welcome back, everybody. Today we're going to be taking a deep dive
Ugh.
into the world of post-trade in financial markets. It may sound a little dry, but trust me, you'll be surprised by what you discover.
Oh, yeah, definitely.
I actually got a whole stack of research papers, regulations, even some news articles,
Ah,
all about central counterparties, trade repositories, settlement systems.
okay.
It's a lot to unpack. Luckily, I'm joined by our expert who's
Yeah.
going to help us navigate this complex landscape
That sounds great.
and understand why this matters to you.
Looking forward to it.
So did you know that even seemingly simple stock trades
Oh, okay.
can actually have hidden complexities and risks,
Right.
and that a single bank in the U.S. actually plays a crucial role
Oh, wow.
in ensuring global currency exchanges go smoothly?
Okay.
We'll also be exploring a recent debate on shortening the settlement time for trades from T+2 to T+1
Uh-huh.
and its potential impact.
Right.
But let's start with the basics. Could you give us a clear overview of what exactly the post-trade life cycle looks like?
Yeah, so the post-trade life cycle
Yeah.
starts right after you hit that buy or sell button.
Okay.
And, it's kind of a sequence of steps
Okay.
that ensures that the trade is confirmed, settled,
Right.
and the cash and securities are actually properly transferred.
Yeah.
It happens for both securities like stocks and bonds
Okay.
and derivatives, which are contracts
Gotcha.
whose value is based on an underlying asset.
So what are the key differences between securities and derivatives when it comes to this post-trade process?
So securities are pretty straightforward.
Okay.
You buy a share of a company.
Yeah.
Once the trade settles, that share is yours.
Right.
Easy.
Simple.
But derivatives are a little more complex.
Okay.
They involve these ongoing obligations
Yeah.
throughout the contract's life.
So it's more than just that initial buy or sell.
Right.
Okay.
There are ongoing payments and obligations to manage.
That makes sense.
So yeah,
Yeah.
it can be a little more complicated.
So where did these trades actually take place?
So you've got two main venues for trading.
Like-
You have on-exchange trading,
Okay.
which takes place in regulated marketplaces like the New York Stock Exchange.
Yeah.
And then you have OTC trading,
Okay.
which is more like private negotiations between two parties.
So on-exchange is more transparent then,
Yes,
and OTC is more of a bespoke agreement.
exact.
Does that difference actually impact the post-trade process at all?
Yeah, it does.
How so?
So on exchanges, trade details are automatically recorded because it's,
Yeah.
a regulated environment.
Right.
But with OTC trades, you have to confirm all the details with your counterparty.
Gotcha.
So that adds another layer.
Right, and risk, yeah.
Yeah.
Now, speaking of risk,
Right.
one term that kind of jumped out at me from the research was
Oh, okay.
substitution risk.
Substitution
This
risk.
sounds pretty ominous.
It is a bit, yeah.
What is it exactly?
It's essentially the risk that the person on the other side of your trade, your counterparty,
Uh-huh.
can't fulfill their obligations.
Right.
So let's say you agree to buy an asset at a certain price,
Okay.
and that price goes up before the trade settles.
Okay.
If your counterparty can't deliver, you miss out on potential profits.
Right.
That's substitution risk.
So it's essentially the risk that someone might back out of a deal
Yeah, pretty much.
when it no longer benefits them.
Yes.
Okay.
And the longer it takes to settle a trade,
Right.
the greater the opportunity for prices to change,
Okay.
and the higher the potential cost if your counterparty defaults.
So time really is money in this case.
Absolutely.
Yeah. Right.
That's why risk mitigation is so critical in post-trade.
Okay.
One of the primary tools used to manage this risk is a margin call.
Margin calls. Yeah.
Yes.
Those always seem kind of,
Yeah.
I don't know, mysterious.
Yeah.
What are they exactly?
There are essentially like an insurance deposit. Okay.
That you put down to protect yourself in case the other party can't follow through.
Gotcha.
There are two main types,
Okay.
variation margin and initial margin.
Okay.
Variation margin covers those day-to-day price fluctuations.
So if the price of the asset moves against you, you might have to pay your counterparty to cover that potential loss.
Exactly.
I
And
don't-
then you have initial margin.
And what about initial margin?
Initial margin is a bit more complex.
Okay.
It's designed to cover potential losses over a longer period.
Okay.
And interestingly, European regulations actually set minimum standards for the parameters used in those models.
So there are actual regulations governing how they're calculated.
That's right.
Okay.
And it highlights how seriously regulators take the potential risks involved in post-trade.
Right.
And it's important because these margin calculations can actually impact market stability.
Now that you mention it, our sources mentioned something about margin calls becoming pro-cyclical.
Yeah.
What does that even mean?
So pro-cyclical essentially means that margin calls can actually exacerbate market volatility in certain situations.
Okay.
So imagine the market experiences a sudden downturn like we saw in March 2020.
Right.
Prices drop,
Yeah.
leading to a surge in margin calls
Right.
as counterparties try to cover potential losses.
Okay.
This sudden demand for cash can force traders to sell assets,
Gotcha.
pushing prices down further and triggering even more margin calls.
So it creates a domino effect.
Yes,
Okay.
where risk mitigation measures end up amplifying the very volatility they were designed to protect against.
Right. That makes
It's
sense.
a delicate balancing act.
Before we move on to those CCPs,
Okay.
I'm curious about other tools used to manage risk and post-trade.
Sure.
Our sources mention netting and trade compression.
Right. So
Can you
netting,
explain how those work?
netting is all about offsetting gains and losses
Okay.
across multiple trades with the same counterparty.
Okay.
So let's say we have multiple open trades.
Okay.
We don't need to settle each trade individually.
We can just net out the overall position,
Yeah.
settling just the difference.
So if I owe you $100 on one trade
Right.
and you owe me $80 on another,
Exact.
we just settle the $20 difference.
Yeah. Okay.
There's another type of netting
Okay.
called closeout netting.
Okay.
This comes into play if a counterparty defaults.
So instead of chasing individual trades,
Right.
you're dealing with one consolidated amount.
Exactly.
Okay.
And then you've got trade compression.
And trade compression.
Trade compression is like spring cleaning for your trading portfolio.
So if two parties have multiple offsetting trades,
Right.
they can basically cancel them out,
Yeah, pretty much.
simplifying their exposure and freeing up resources.
Exactly.
Okay.
So all of these tools kind of work together
Huh?
to create a more robust
Okay.
and resilient post-trade environment.
But even with all these safeguards,
Yeah,
things can still go wrong.
absolutely.
What happens when a counterparty defaults? That's where these central counterparties, or CCPs, come in.
Okay, so CCPs.
CCPs,
Okay.
they act as this central hub for managing risk.
Okay.
They step in between the buyer and seller in every trade,
Okay.
becoming the buyer to every seller and the seller to every buyer.
So instead of worrying about the creditworthiness of each individual counterparty,
Yes,
everyone just deals with the CCP.
exactly.
That sounds like a huge responsibility.
It is.
How do they actually mitigate all that risk?
They have a whole toolkit at their disposal.
Okay.
We've already talked about netting, trade compression.
Right.
They also require their members to post margin,
Okay.
both variation and initial,
Okay.
to cover potential losses.
And they have that default fund.
They have a default fund, which acts as a last resort
Right.
in case a member defaults.
Right.
And their margin isn't enough to cover the loss.
So it's like a layered defense system,
Exactly.
starting with margin and ending with the default fund as the final backstop. That's a good way to put it.
And to further mitigate risk, CCPs have strict membership requirements.
Right. So not every market participant
Okay.
has direct access to a CCP.
Okay.
Some operate as clients of participating members,
Okay.
while others are even further removed
Okay.
as indirect clients.
So it's a tiered structure with the CCP at the top,
Yes.
then members, clients, and indirect clients.
That's right.
But that means that while the CCP manages risk for its direct members,
Yeah,
there's still counterparty risk outside that central hub, right?
that's true.
So it's not a perfect system,
The system is perfect.
but it seems like a significant step towards making the market safer and more stable.
Absolutely.
Now, we've covered a lot of ground already,
Oh, yeah.
from substitution risk to the role of CCPs. But our exploration doesn't stop there.
Oh, good.
In the next part of our deep dive, we'll look at how CCPs manage defaults.
Okay.
We'll delve into the intricacies of security settlement.
Yeah. And we'll unpack the crucial role of central securities depositories.
Sounds good.
We'll be back after a short break.
Great.
Welcome back to our deep dive into the world of post-trade.
All right.
It's covered a lot of ground, from substitution risk to the role of CCPs.
Yeah.
But our exploration doesn't stop there.
Okay.
We're moving on to another key player in the post-trade landscape,
Okay.
central securities depositories, or CSDs.
CSDs. All right.
Wait.
So what are CSDs? CSDs are essentially the guardians of the financial markets.
Okay.
They hold securities on behalf of their participants,
Okay.
ensuring safekeeping and facilitating the efficient transfer of ownership.
So when I buy a stock these days,
Yeah.
it's not like I'm getting a physical certificate anymore.
Right.
It's more like an entry in a massive digital ledger
Yeah.
maintained by a CSD.
Exactly.
Okay.
So CSDs have revolutionized the way securities are held and transferred,
Right.
eliminating the need for those physical certificates and streamlining that settlement process.
Speaking of settlement, we've talked about netting for mitigating counterparty risk,
Uh-huh.
but our sources also mention netting in the context of securities settlement.
Right.
Is it the same concept?
It is, but applied a bit differently.
Okay.
So in securities, settlement
Yeah.
netting refers to bundling transactions together and settling only the net difference.
So instead of two separate transactions,
Right.
it's treated as one consolidated movement of shares.
Exactly.
Alright.
So netting reduces the volume of securities and cash that needs to be transferred,
Right.
making the process faster and less expensive.
Okay.
But it also carries a higher level of risk.
Okay, how so?
Because if one participant defaults,
Yeah,
it can impact the entire chain.
that makes sense.
So there's
So what's the alternative to netting and securities settlement?
the alternative is gross settlement.
Okay.
In gross settlement, each transaction is settled individually,
Okay.
regardless of any offsetting positions.
So with gross settlement, there's no risk of a domino effect if one party fails to deliver.
Yes.
Okay.
It's considered a safer approach,
Right.
but it comes with its own costs in terms of liquidity
Okay.
and resource requirements.
Our sources also mention different models of settlement,
Okay.
models 1, 2, and 3.
Yeah.
What are the key differences there?
So these models differentiate themselves based on how the securities leg
Yeah.
and the cash leg of a transaction are settled.
Okay.
Model 1 is the simplest.
Okay.
Both legs are settled simultaneously.
So it's like a synchronized handover.
Yes, exactly.
Okay.
It's fast and efficient,
Right.
but carries a higher risk of both parties failing to deliver,
Okay.
which is known as principal risk.
And model 2?
Model 2 aims to reduce that principal risk
Okay.
by settling securities on a gross basis throughout the day,
Okay.
while the cash leg is settled on a net basis at the end of the day.
So with model 2, the securities change hands first,
Right.
followed by a consolidated cash settlement at the end of the day.
Exactly.
And model 3?
Model 3 is the most risk-averse approach.
Oh, okay.
It settles both securities and cash on a gross basis throughout the day.
So model 3 is the most cautious,
Yes.
but likely requires the most liquidity to operate smoothly.
That's a good summary.
Earlier, we discussed the role of CCPs
Uh-huh.
in mitigating counterparty risk.
Right.
How do they fit into this world of securities settlement,
That's a great question.
particularly with these different settlement models?
It highlights a key consideration for CCPs,
Okay.
which is liquidity management.
Okay.
So remember,
Yeah.
CCPs become the counterparty to every trade,
Right.
which means they need significant liquidity
Right.
to meet their settlement obligations,
Well,
especially in a gross settlement environment.
can you give me an example to illustrate this point?
Sure. Yeah.
Imagine a CCP operating in a Model 3 environment
Okay.
where everything is settled on a gross basis.
Okay.
So let's say the CCP receives instructions to deliver $100 million worth of securities to Party A.
At the same time, it needs to receive $100 million from Party B
Right.
for the same securities.
Right.
So while the CCP's position is theoretically balanced,
Right.
it still needs to have that $100 million readily available
Right.
to make the payment to Party A,
Okay.
even if Party B's payment is slightly delayed.
So even if the CCP's overall position is neutral,
Yes.
it needs a substantial buffer of liquidity to handle those potential
Right.
timing discrepancies in settlement.
Exactly.
Right.
And this need for robust liquidity management becomes even more crucial
Right.
when you consider systems like Target 2 Securities
Okay.
or T2S. T2S,
Okay.
a major platform for securities settlement in Europe.
I've heard of T2S, but
Yeah.
I'm not entirely sure what makes it so special.
So T2S is a game changer
Oh.
for European security settlement.
Okay.
It harmonizes settlement processes across the region,
Okay.
aiming to create a single, efficient platform. It has the potential to reduce costs, improve liquidity, and enhance transparency.
Okay.
One key aspect is how T2S interacts with cash leg settlement.
Okay.
There are two models, interfaced and integrated.
Can you break those two models down for me?
Sure. In
No.
the interface model, the cash leg is settled outside of the CSD.
Okay.
But the CSD retains control over the payment instructions,
Okay.
ensuring synchronization between the cash and securities legs.
So the integrated model.
The integrated model takes this a step further,
Okay.
with both securities and cash settled within the CSD's own system.
So with an integrated model, the CSD is essentially handling both sides of the
Yeah.
transaction under one roof.
That's right.
Okay.
It's a more streamlined approach,
Mhm.
but requires robust liquidity management within the CSD
Gotcha.
to function effectively.
Now, despite the initial enthusiasm for T2S
Mhm.
and its potential to revolutionize cross-border settlement in Europe,
Yeah.
the adoption of cross-CSD settlement,
Yeah.
where securities held in different CSDs are exchanged,
Yeah.
has been surprisingly low.
It has been surprisingly low.
Why do you think that is?
There are several factors at play:
Okay.
legacy systems, operational complexities,
Right.
and perhaps even a bit of inertia within the industry have hindered wider adoption.
So the potential benefits remain significant,
They do.
but the adoption has been slow.
Yes.
We've talked about efficient settlement,
Yeah.
but what about when things don't go as planned?
Right.
How does the system deal with those who fail to deliver
Okay.
on their settlement obligations?
So that's where settlement discipline comes in.
Okay.
And in Europe,
Yeah.
the Central Securities Depositories Regulation,
Okay.
or CSDR,
Good.
introduces a controversial measure
Okay.
known as the mandatory buy-in regime.
The mandatory buy-in regime.
Yeah.
What makes this buy-in regime so controversial?
Essentially, it's a penalty mechanism for failed settlement instructions.
Okay.
So if a party fails to deliver securities as agreed,
The buyer can initiate a buy-in,
Okay.
forcing the seller to repurchase those securities in the market.
so it's a way to ensure the buyer isn't left empty-handed,
Exactly.
even if the seller can't deliver.
Yes.
Okay.
However,
Yeah.
critics argue that this buy-in regime
Uh-huh.
could have some unintended consequences.
Like what?
For example,
Yeah.
in a volatile or illiquid market,
Okay.
executing a buy-in could be challenging,
Right.
potentially exacerbating price fluctuations and harming overall market liquidity.
So forcing a purchase in a turbulent market
Right.
could create a ripple effect,
Yeah.
pushing prices up further.
Yeah.
Are there any other concerns?
Another criticism is the potential impact on market makers.
Okay.
The entities that provide liquidity by constantly quoting prices
Right.
for buying and selling securities.
Okay.
So they often find themselves on both sides of trades,
Right.
and under the buy-in regime,
Yeah.
they could be penalized for a failed settlement.
Even if they had every intention of settling shortly.
So it could create unnecessary penalties for market makers,
Yes.
potentially discouraging them from providing liquidity and ultimately harming the market's smooth functioning.
Exactly.
It also creates an asymmetry between buyers and sellers.
It does.
It sounds like a complex issue
It is.
with potential drawbacks alongside its intended benefits.
Definitely.
So what's the current status of this buy-in regime?
Well, it remains a contentious issue.
Okay.
Industry groups are voicing concerns
Right.
about its potential impact on EU markets,
Right.
particularly the bond market.
Okay.
They argue that it could lead to increased costs,
Right.
reduce liquidity,
Okay.
and potentially drive trading activity to venues outside the EU.
So it's a classic case of trying to find the right balance
Yes.
between promoting settlement discipline
Uh-huh.
and avoiding those unintended consequences
Right.
for market participants.
So, yeah, it's...
We talked about CSDs and
Yeah.
settlement. But what about the actual holding of securities?
Okay.
How are those assets safeguarded and managed within the system?
That's a crucial aspect of post-trade.
Okay.
It's all about maintaining a clear chain of custody,
Right.
ensuring those securities are held securely and segregated,
Right.
and that there's a clear trail of ownership
Yep.
from the issuer to the final investor.
So it's like a system of checks and balances
Exactly.
to track ownership and protect assets.
Precisely.
And there are different regulatory frameworks governing
Uh-huh.
how securities are held at investment firms or banks
Yeah.
versus how they're held at CSDs.
Correct.
Can you explain the key differences between those frameworks?
Sure.
Like,
So for investment firms and banks,
Yeah.
the key legislation is MiFID II. MiFID II emphasizes the protection of client assets
okay.
and requires firms to segregate client securities from their own holdings.
So it adds a layer of protection for its clients' assets.
Right. MiFID II also requires regular account reconciliation, ensuring the firm's records match the actual holdings at the custodian.
So it's all about transparency and accountability.
Yes.
Now, for CSDs,
Yeah.
the governing regulation is CSDR.
Right.
How is that different?
So CSDR focuses on the safekeeping and efficient transfer of securities within the CSD system.
So while MiFID II focuses on protecting client assets at the firm level,
Yes.
CSBR is more about safeguarding the overall integrity of the CSD itself.
Exactly. Both frameworks play a crucial role
Right.
in building a robust and trustworthy post-trade ecosystem.
As we delve deeper into the post-trade world,
Uh-huh.
it's becoming clear that it's a complex and interconnected ecosystem,
It is.
with various players and regulations
Yeah.
working together to ensure things run smoothly.
That's a great observation.
And our journey through this fascinating landscape continues
Oh, good.
as we explore another layer of complexity:
Okay.
corporate actions.
Corporate actions.
Up next, we'll unpack the intricacies of corporate actions and the challenges of managing these events within the post-trade framework.
That's good.
Stay with us. Welcome back to our deep dive into the intricate world of post-trade. We've explored the journey of a trade, from execution to settlement, encountering CCPs, CSDs, and a whole array of risk mitigation tools along the way.
Yes.
But our exploration doesn't stop there. We're going to encounter another layer of complexity
Okay.
that can significantly impact the post-trade landscape, and that's corporate actions.
Corporate actions.
They might not sound as
Yeah.
thrilling as, margin calls or default waterfalls,
Right.
but our sources suggest that they play a crucial role in the post-trade ecosystem.
They do. Corporate actions are essentially events initiated by a company
Okay.
that affect its securities.
Okay.
So think about stock splits,
Yeah.
dividends, mergers, or rights issues.
Okay.
Anything that alters the characteristics or ownership structure of a company's shares or bonds?
So when a company decides to issue a dividend or split its stock, it triggers a chain reaction that impacts shareholders, bondholders,
Yes.
and the entire post-trade infrastructure.
Exactly.
It sounds like a logistical challenge,
It is.
especially given the wide variety of corporate actions that companies can undertake.
Yeah, that's one of the key challenges in managing corporate actions.
Okay.
There's a vast array of event types,
Right.
each with its own set of rules and procedures.
Our sources categorize corporate actions in a few different ways.
Okay.
Can you walk me through those categorizations?
Sure.
Okay.
One way is based on the type of event.
Okay.
You have distribution events,
Okay.
where the company gives something to its shareholders,
Okay.
like dividends or bonus shares.
Okay.
Then there are reorganization events,
Okay.
which alter the structure of the company or its securities,
Okay.
such as mergers or stock splits.
Okay.
And then there are participation events,
Okay.
where shareholders exercise their voting rights,
Okay.
typically during general meetings.
So it's about how the corporate action impacts the relationship between the company
Right.
and its investors.
Exactly.
Another crucial distinction is whether an event is mandatory or voluntary.
That's right.
So mandatory events, like dividend payments,
Mhm.
occur automatically,
Yeah.
while voluntary events, like rights issues,
Yes.
require shareholders to make a choice.
Exactly.
So a mandatory event is essentially saying,
Yeah.
here's something you're getting, no action needed on your part.
Right.
While a voluntary event is more like,
Yes.
here's an opportunity, you decide whether to participate.
You got it.
And this distinction between mandatory and voluntary
Yeah.
has implications for the complexity of the post-trade process.
Absolutely.
How so?
Mandatory events are generally more straightforward to handle
Okay.
because they involve less decision-making from investors.
Right.
Voluntary events require more communication and processing, as investors need to be informed of their options,
Right.
and their choices need to be recorded and implemented.
It sounds like voluntary events add an extra layer of complexity than
That's true.
requiring the system to track and process individual investor decisions.
Exactly.
There were even events that fall somewhere in between mandatory and voluntary,
Right?
known as mandatory with options events.
Yeah, mandatory with
These events give investors a choice within a defined set of options.
Yes,
So it's like
Yeah.
saying you have to participate, but you get to choose your flavor.
that's a good way to put it.
These mandatory with options events
Huh?
can be just as complex as voluntary events,
They can't, yeah.
as investor choices still need to be processed and implemented.
Exactly. So,
Yeah.
yeah, it's a bit more complex.
Given the complexity and variety of corporate actions,
Right.
what are some of the key challenges in managing these events?
Well, one of the biggest challenges is ensuring seamless communication between all the parties involved.
Okay.
So you've got the company initiating the action,
Right.
the CSD managing the securities, intermediaries like brokers facilitating the process,
Uh-huh.
and ultimately the investors themselves.
It sounds like a lot of potential for miscommunication and errors
It is.
if information isn't flowing smoothly through that chain.
Yeah. Any breakdown in communication can lead to confusion,
Right.
errors, and even costly disputes.
Okay.
Another challenge is the operational complexity.
What do you mean by operational complexity?
It's about managing all those nuts and bolts of the process.
Okay.
Things like collecting and processing investor instructions,
Okay.
allocating and transferring securities,
Right.
and making sure payments are executed correctly.
So it's not just about communication.
It's not just about communication, no.
It's also about having the right systems and processes in place
Right.
to ensure the corporate action is implemented
Yes.
accurately and efficiently.
Absolutely.
Our sources mentioned the importance of market standards
Right.
in managing corporate actions.
They play a crucial role.
How do these standards help address the challenges we've discussed?
So market standards aim to streamline communication
Okay.
and standardize processes,
Okay.
reducing the potential for errors and confusion.
Okay.
For example,
Yeah?
they establish clear roles and responsibilities
Okay.
for each participant,
Right.
ensuring that information flows smoothly.
Yep.
And everyone knows what's expected of them.
So it's like having a clear roadmap for navigating the corporate action process
Exactly.
with everyone understanding their part.
Yes.
Okay.
And these standards also specify the type of information that needs to be communicated,
Right.
like the details of the corporate action,
Okay.
key dates, and procedures for handling investor choices.
By standardizing the information and the process,
Right.
you reduce ambiguity
Absolutely.
and minimize the risk of misunderstandings.
Precisely.
Okay.
Market standards also address the operational aspects of corporate actions.
Okay.
They provide guidelines and best practices for tasks, like collecting investor instructions, allocating securities,
Yeah.
and processing payments.
It sounds like these standards are crucial